read and what you guys wanted is the theory and the philosophy behind what we're actually doing. This is very important because if you understand that, you will understand that every deal is different and you can't follow one size fits all approach to every single deal. But if you understand philosophically what your covenants do, what they're trying to achieve, then you might find that certain covenants are very strong for a certain client. And you'll see we'll have two case studies. Certain covenants work really well. I'll give you an example. If you have an amortizing facility where you have a contractual debt service obligation, so the client has to pay a certain capital installment periodically, and that's in your legal agreements. Okay. Then you can use a debt service cover ratio because you know what's coming in the future. Okay. So you know what's contracted. And if the client doesn't fill their end of the bargain, then they are in breach or in a situation of default. Okay. So that works really well for, say, something like a debt service cover ratio where it's contractual, it's objective. You both know what to expect in the future. And if somebody fails to deliver, well, unfortunately, they're in breach. And whatever remedies that you guys decide to take forward, you're well within your rights because that's in your legal agreements. Now, take the same client if you gave them a revolving credit facility, for example. So you didn't tell them that they need to pay down the RCF on specific dates. Technically, yes, the loans do become due on a certain interest payment date, but they can just roll them over, and some legal agreements allow them to do so automatically. So you can't really say to the client, um, based on the cash flow of this period, we see that the debt outstanding and the amount of cash flow is a little bit too thin for us, for our liking. Maybe they're using the RCF to protect themselves in the event of a strike. So you can't tell the client in that case that we actually don't want you to draw. We're going to put a draw stop on the RCF. You can't enforce a draw stop in that scenario because it can't be contracted for. That debt service cannot be predicted in the future. They probably didn't predict exactly when that strike would occur. So they couldn't have predicted how much they draw on the RCF. Consequently, they couldn't have predicted how much interest burden they'd have on the RCF. And consequently, because your debt service cover ratio only covers capital and interest, contractual capital and interest, maybe your debt service cover ratio won't even bite, despite the fact that this client is now heavily overgeared. So maybe for an RCF, for example, you might need another type of covenant. So we will cover that in the first session, just the theory of why you would need certain covenants and why certain covenants would be suited to certain companies and why they would be unsuitable for other companies. So the most fun that you'll have with modeling comes when you are doing project financing. When you're doing the corporate stuff, it tends to be relatively homogeneous, and the only battle that you have is more or less on the pricing side and to see what ancillary business that you can get from the clients. But it's not really heavily structured when you're dealing with a Sibanye or when you're dealing with a very well established Harmony or a very well established mining corporate. They know what they want. They have a sophisticated treasury team. They've got their bonds that are trading in the market. They've got their working capital facilities, and they just need that slab that forms the long-term capital structure of the business, plus some contingency RCF. So it'll be a cut and paste every 3 or 4 years when they refinance. And the main battle there is on the pricing among the banks because every bank wants a piece of those major clients. So we're not going to do any RCF modeling because it's just you can't really model an RCF, but we will see which covenants protect you in the event that a client just has a large RCF. The main fun that you have when you're sculpting is when you've got either a mining project that's expanding. So they've already got existing operations. We call that a brownfields project. So they've already got existing operations, but they're just expanding those operations. Or you've got a greenfields project where there were no previous operations and they're doing this for the first time. And they have a construction period, a ramp up period, and then they've got a period where they'll be generating sufficient cash in order to repay the debt. So then you'd have to sculpt your debt in line with their cash flows.